The intent of this video is not to bash Meet Kevin's market views. The intent is to provide dialogue and share my own opinions on the market based on things that he has recently stated in his videos. So without further ado, let's get started. Let's talk about things that were stated in his video recapping what Jerome Powell said at the Brookings Institute on November 30th. In this video, he was extremely ecstatic about the fact that he believes Jerome Powell was very dovish.
That because this was so dovish,
Called for a Santa Claus rally.
Folks, I have good news. I think Santa Claus is coming to town this year.
He stated that the Federal Reserve thinks a wage price spiral is unlikely.
We're not seeing signs of a wage price spiral, so while there's still some work to do here, we're on the right track.
And that the Federal Reserve thinks that they are winning.
He's basically telling you, look, we're winning. This was him going, we are winning.
He also stated that if CPI comes in lower than expected, we can expect a stock market rally that will be, in his own words, glorious. And you do not want to be short the market.
The next 6 months in the stock market, I expect will be glorious.
Glorious!
I would not short this market.
My views are somewhat different. I watched the press conference, I watched Jerome Powell, and I did not have the same reaction. He was not as hawkish as he was before, but that does not mean that he was dovish in my personal opinion. He thinks that rates will still go higher and that they will be higher for longer. While I agree that we basically locked in a 50 basis point move for the next meeting, I also think the investors are failing to realize that 50 basis points still impacts the real economy. And by no means can we classify this as a Federal Reserve pivot. The federal fund rate at the end of the day is still moving higher, and this will likely lead to an earnings decline in my personal opinion. So even though we might start to see the Federal Reserve cut back on the amount that they're increasing and eventually pause, I think they're going to hold there for longer than expected, and I think there's limited upside to any stock market rally because the impacts that those interest rates and quantitative tightening will have on the real economy and company earnings. So any rally will be limited to the upside by valuations. An earnings decline could result in stocks having to fall just to maintain the same price to earnings ratio. And on top of that, if we head into a recessionary environment, we can also see a multiple compression, meaning that the average price to earnings multiple for the stock market overall will decrease. That's a double whammy. You have a decrease in earnings itself, and you also have a decrease in that multiple, which is a huge risk to the stock market and can bring stocks much lower. It also creates a very low ceiling for any stock market rally, in my personal opinion. So all in all, the risk to reward is still heavily favored to the downside. So yes, in theory, a lower than expected CPI will likely lead to a short-term bump in the stock market, but by no means will it be glorious in my personal opinion. Now, let's go over a different video. This one I found to be much more interesting. It's a more recent video in where Meet Kevin goes over the possibility and what he thinks might actually happen in that the Federal Reserve will have to cut rates down to zero. He's calling for massive rate cuts in 2023, going from around 5% to 0% in that time.
We need to talk about massive rate cuts coming from the Federal Reserve. This means the market is pricing in that the Federal Reserve will have to cut rates completely back to zero.
On the flip side of this, Jamie Dimon, the CEO of JP Morgan, recently had an interview in which he thinks that rates are going to go to 5% and stay there for longer.
You said 5%. You really think that's where rates are going to stop, the terminal rate?
I think the Fed has made it clear they're going to get to 5 and stop for a while. I read a while as 3 to 6 months. That may not be sufficient,
which has been the message of the Federal Reserve for this whole time. Now, the basis for Meet Kevin's call for rates to go down to 0% is based on a trend line from a graph that incorporates the inversion of the 2-year and 10-year Treasury and how deeply it's inverted. It tells you how many basis points the Federal Reserve will have to cut rates. Here's the graph, and here is what Meet Kevin is saying.
Look at this, folks. If we're at 77 BP of max inversion, draw that to the blue line, come down, and what do you get, folks? Total Federal Reserve easing predicted by this chart is 5%, or 500 basis points. This means the market is pricing in that the Federal Reserve will have to cut rates completely back to zero.
The issue I see with using this trend line is twofold. First, we have to consider where rates were in the 1980s. because these two data points are skewing the trend line in my personal opinion. And second, we need to consider where we were just 2 years ago. In the 1980s, the Federal Reserve under Paul Volcker had to raise rates ultimately to 20%. This was because of raging inflation that they got wrong the first time around. They took their foot off the brakes too early, gassed up the economy, and it led to inflation coming back stronger than it was before. Earlier, they had rates at 14% to tackle inflation the first time around. We are currently under 5%. Now, this form of monetary policy has been mentioned by Jerome Powell before in other FOMC meetings. He often uses the word or the phrase keep at it, referring to the mistake Paul Volcker made during his term and that he will not make the same mistake. He wants to keep at it until inflation is done for good. This was also something I covered in a prior video of mine, in which we went over Michael Burry's recent tweets about the Federal Reserve. He stated that this Federal Reserve is so afraid of being the Federal Reserve of the 1970s that they're going to end up being the Federal Reserve of the 1930s. The Federal Reserve of the 1930s did not cut rates, and we had the Great Depression, but ultimately we climbed out of it. So all in all, Jerome Powell and the Federal Reserve, in my personal opinion, will be very hesitant to decrease rates too soon. So the issue with the trend line is that it uses rates from the 1980s at 14 and 20%, which steepens the trend line, which then steepens how much they have to cut. Second, we need to consider why we are where we are. We are here because of awful monetary policy and fiscal policy. We are here because the Federal Reserve doubled the size of their balance sheet, printing $4 trillion, going from $4 trillion to $8 trillion during the pandemic. We are here because of a decade-long period of low rates because of the great financial crisis. We're coming from 0% rates. To go back to 0% rates, which got us where we are today, would be idiotic in my personal opinion, and would only happen if we are in a severe, deep recession and inflation is no longer a worry, and that the Federal Reserve is willing to make the same mistake they did before. While this is possible, and maybe even likely because the Federal Reserve can never get anything right, it seems like, I do not think it's going to happen in the next 6 months. These things can take years to play out. So in one video, he calls for a glorious stock market rally, and then in the other video, he's calling for rates to go back down to 0%. Maybe they're one and the same, but I find it very hard to believe that we do not see lower lows if the Federal Reserve has to cut rates to 0%. This would only happen in a dire situation. My personal opinion is that there's a higher probability of lower lows in the next 6 months. It's likely we are going to retest those lows and potentially even break them. I think that probability is much higher than the stock market making a new high. I think we will see a significant decline in earnings. I think that the Federal Reserve will keep rates at 5% or higher for longer. And I think that ultimately we are going to have a recession and it's going to be quite severe. I don't think the Federal Reserve will cut rates until at least mid to late 2023. One thing I did want to mention is if you're interested in joining a community of investors and traders, you can do so by joining the Patreon, which will give you access to this private Discord server. The costs are extremely cheap. It's only $5 a month. Keep out scammers. In comparison, other similar Discord servers will charge you over $100 per month. In this Discord server, you are going to be alerted of my live trade alerts. I post them on a dedicated channel. There's also stock market and investing discussions that happen in the general chat. We also have briefings and we go over stock market news and Twitter updates. We'll also mention tickers down in a watch list channel. The purpose of this is to build a community of like-minded individuals so that we can grow together as better investors and traders. The trading strategy that I implement is suited for traders who have a small account. They provide high risk-reward trading opportunities where you don't need much money to get into. Here are some examples of trades that we have had over the last couple of months. And the most recent trade from this week, shorting CrowdStrike, was up over 400% and can continue to climb to be more than 1,000% returns. And that trade to get into one contract would only cost you $10. Those are the kind of opportunities and the kind of risk reward profiles we search for. Now, if you're interested in joining, there's a link in the video description. I hope to see you there. But that concludes this video. Those are my personal opinions. Let me know what you think in the comments section down below. And do not forget to subscribe to this channel. This is We Are Investing, and together we are invincible. See ya.